Some of the biggest financial mistakes people make aren't due to lack of funds. It's due to lack of understanding. They just don't know how the financial system works. And today we're addressing that head on. I'm Christiana Lovelace. I'm a licensed financial advisor, an accredited asset management specialist, and the owner of Diamond Point Financial. Each week on Pointe Perspective, we break down the markets, the economy, and financial planning into practical conversations that help you make more informed financial decisions. This week, we're pulling back the curtain on 3 financial systems that influence millions of people every day. First, we'll explore how quantitative investing has helped professional investment managers evaluate portfolios for decades, long before artificial intelligence was even part of the conversation. Then, we'll discuss why the stock market and the economy don't always seem to move together, and why understanding that relationship can completely change the way you interpret financial headlines. And finally, we're beginning a new planning series on credit by exploring the history, the purpose, and the intention behind credit scores. The better you understand how the system works, the more confident you'll become in making decisions within it. Artificial intelligence has become one of the biggest stories in investing over the past few years. We've talked about it several times here on Pointe Perspective, and one of the questions I continue to receive is how it's actually used in our practice at Diamond Point Financial. And while nearly every financial firm is incorporating AI into its business, what many people don't realize is that similar technology has been helping professional investment managers make portfolio decisions for decades. Long before ChatGPT, many institutional investors relied on what's known as quantitative investing, or quant investing for short. Rather than relying solely on opinions or intuition, quantitative investing uses mathematical models to evaluate companies using measurable financial characteristics. Today, trillions of dollars are managed using some form of quantitative strategy. Many of the ETFs, mutual funds, and separately managed accounts investors own today incorporate quantitative models somewhere in their investment process. So how does a quantitative model work? While it isn't artificial intelligence in the way we typically think about it today, it follows many of the same principles by using computers to evaluate enormous amounts of information quickly and consistently. Imagine you're trying to evaluate 5,000 publicly traded companies. No analyst can realistically read every annual report, compare every balance sheet, and calculate every valuation. Instead, quantitative models score companies using predetermined factors. So for example, a model might ask, has earnings growth exceeded 15%? Does the company generate positive cash flow? Is debt below a certain percentage? Is return on equity above the industry average? And is the stock trading at an attractive valuation? Each of those measurements tells us something different, and every company receives the exact same evaluation. Think of it like how a report card evaluates several subjects to measure a student's overall performance. Quantitative models evaluate multiple financial measurements to assess the overall strength of a company. In investing, these characteristics are often called investment factors. They don't predict the future, but they can provide a consistent way to compare one company against another. So a process that might take a team of analysts weeks can often be completed by a quant model in a matter of minutes. Then, in some investment strategies, those evaluations don't simply inform a portfolio manager. They actually drive the investment decisions themselves. In some scenarios, if a company meets the model's criteria, it may be added automatically. Or, if it no longer meets those standards, it may be reduced or removed during the next scheduled rebalance. Rather than relying on human judgment for every trade, the model consistently follows the rules as it was designed to apply. So where does artificial intelligence fit into all of this? Traditional quantitative models primarily analyze numbers, but artificial intelligence allows computers to analyze language. Today, AI can summarize hundreds of pages of SEC filings in minutes. It can compare earnings calls quarter over quarter, identify recurring themes, and even detect subtle changes in language that may suggest executives are becoming more optimistic or more cautious about the future. That's something that traditional quant models weren't designed to do because they primarily analyze structured numerical data rather than language. Today, we're able to use sophisticated software to monitor risk exposure, evaluate portfolio diversification, identify tax loss harvesting opportunities, rebalance portfolios, and run retirement projections across thousands of different market scenarios. Most of this happens behind the scenes, so clients rarely see it, but it's become an important part of how modern portfolio management is performed. These tools help us become more efficient, but they're still just tools. Even advanced technology doesn't know your retirement goals or your family dynamics. It doesn't know your business, your tax situation, or how comfortable you are with market volatility. At Diamond Point Financial, we've embraced technology because it allows us to spend less time gathering information and more time interpreting what that information actually means and how it can serve our clients. Technology may help us organize and process information faster, but experience and judgment helps us determine how those patterns fit into our client's overall financial plan. So the goal isn't to replace people with technology, it's to use better technology to make better informed decisions for the people we serve. One of the biggest misconceptions the general public and many investors have is that the stock market reflects the current economy, when in reality, markets are constantly trying to estimate what the economy may look like 6 to 12 months from now, so it's always moving ahead. And that completely changes how investors interpret headlines. One thing economists often do is separate information into two broad categories. Leading indicators attempt to provide clues about where the economy may be heading. Things like manufacturing activity, building permits, consumer expectations, and even the stock market itself often begin changing before we see those changes reflected in the broader economic reports. Other reports like gross domestic product, employment, inflation, and retail sales help us understand where the economy has been. They're incredibly valuable, but by the time they're published, investors are already trying to evaluate what comes next. Take gross domestic product, or GDP, for example. Technically, it's actually considered a coincident indicator since it reflects the present state, but it measures everything the country produced during the previous quarter. And by the time that report is released, businesses are already operating in the next quarter. The same is true for many of the reports we follow throughout the year. They're important because they help us understand where we've been, but markets are usually asking what happens next. The stock market is constantly trying to estimate the future profitability of businesses because over the long term, stock prices tend to follow earnings. If investors believe corporate earnings will improve over the next year, stock prices often begin moving before those earnings ever appear in a financial statement. Likewise, if investors expect profits to slow, markets may begin declining months before we see meaningful weakness in the broader economy. We've seen that happen many times, even in the last 10 years. In 2022, the market began declining well before we saw meaningful slowing in the economic growth. Investors were reacting to the expectation that persistent inflation and aggressive Federal Reserve rate hikes would eventually slow corporate earnings, hiring, and economic activity. Over the following year, many of those expectations gradually began showing up in the economic data. We saw something similar in late 2018. The S&P 500 fell nearly 20% as investors became concerned that the Federal Reserve would continue raising interest rates into an already slowing economy. A few months later, the Federal Reserve reversed course and eventually began lowering rates as economic conditions softened. The market was reacting to what investors believed the Federal Reserve would eventually have to do, and then when those expectations changed, so did the strategy. So while the evening news usually asks what happened today, markets ask what is most likely to happen next. And that doesn't mean markets are always right. We don't have a crystal ball, only the information presented in front of us and a historical backdrop to apply it to. Markets constantly adjust as new information becomes available, and sometimes those expectations prove to be wrong. That's why successful investing isn't about being right all the time. It's about adapting when the facts change while staying disciplined to your long-term plan. Over the next several weeks, we're going to spend some time discussing one of the most important financial tools you'll use throughout your life, your credit. Almost everyone has heard of a credit score, but surprisingly few people understand what it measures, who calculates it, and why it exists in the first place. So before we start talking about improving a credit score or using credit strategically, it's important to understand the system itself. First, credit wasn't always evaluated the way that it is today. Before the 1950s, borrowing money was often a very personal process. Local bankers relied heavily on interviews, handwritten notes, and personal relationships to decide whether someone qualified for a loan. That meant that two people with nearly identical financial situations could receive completely different decisions simply because they applied at different banks or they spoke with a different loan officer. There wasn't an objective standard, which created inconsistent lending decisions, but also opened the door for discrimination and personal bias. But that all changed in 1956 when engineer Bill Fair and mathematician Earl Isaac founded what eventually became Fair, Isaac and Company, better known today as FICO. Their goal wasn't to decide whether someone is a good person. It was to create a more objective and consistent way for lenders to evaluate risk. Today, FICO scores are used in the vast majority of lending decisions across the United States. So what is a credit score? A credit score is simply a numerical estimate, typically ranging from 300 to 850, evaluating how likely someone is to repay borrowed money based on their past credit history. Notice what I didn't say there. It's not a measure of your income. It's not a measure of your net worth or your intelligence. It is a risk assessment tool. So in other words, lenders aren't asking how successful is this person. They're asking, based on this person's borrowing history, how likely are they to repay this loan? Today, there are three major credit bureaus in the United States: Experian, Equifax, and TransUnion. These companies don't actually decide whether you're approved for credit, nor do they create most of the scoring models. Their primary job is collecting and maintaining your credit history. They collect information reported by lenders, and that information is then used by scoring models like FICO and VantageScore to calculate a credit score. That's also one of the reasons you may notice different credit scores depending on where you check them. They're often using different scoring models while pulling from very similar information. Credit scores are calculated using several factors that evaluate your borrowing habits. And next week, we'll break down exactly what those factors are and how each one affects your score. Whether you're buying your first home, refinancing a mortgage, or purchasing a car, your credit history can influence how expensive those decisions become. Even beyond that, a strong credit score can influence much more than loan approvals. It may affect the interest rate you receive, apartment applications, insurance premiums in many states, and even certain employment screenings. One of the easiest things you can do periodically is to review your credit report. Errors happen more often than people realize. You'll want to look for incorrect balances, accounts that don't belong to you, signs of identity theft, or simple reporting mistakes that could affect your credit history. Federal law allows you to obtain a free copy of your credit report from each of the three major credit bureaus through annualcreditreport.com. I generally encourage people to review their report at least once a year, even if you're not planning to borrow money. It's one of the simplest financial checkups you can perform. I also appreciate that many banks and credit card companies now provide credit scores directly through their apps or monthly statements. Now, the score you see may not be the exact score a lender uses, but it's still an excellent way to monitor trends and identify changes over time. Over the next few weeks, we'll build on this foundation. We'll discuss how to use credit strategically throughout your lifetime and how parents can help teach the next generation to build strong financial habits before they ever apply for their first loan. At the end of the day, credit isn't about borrowing as much money as possible, and it isn't something to fear or avoid. It is a financial tool. When it's understood and used responsibly, it can open doors, reduce costs, and create opportunities throughout your lifetime. Today, we explored how technology and quantitative investing help professional investment managers process information more efficiently. We discussed why markets often move before the economy, and we began our new series on credit by exploring why credit scores exist and how they're designed to measure risk. Next week, we'll take that a step further by breaking down exactly how credit scores are calculated, what factors influence them, and some of the biggest misconceptions that continue to circulate online. If you found today's discussion helpful, be sure to subscribe to this channel for new episodes every week, and to receive our weekly Pointe Perspective newsletter, you can enroll using the link provided. Maybe you have questions about your own financial situation and you'd like to learn more about Diamond Point Financial. You can visit our website or schedule a conversation with us using the information below. I hope this offered some useful perspective, so until next week, take care.